We go to chapter 12 in business, pricing strategy. So before, let's separate pricing and strategy. Let's separate them. When we talk about a strategy is just a plan that you use to ensure that you're able to achieve your objective. That's what the strategy is. A set of plan that you put in place to ensure you are able to achieve your objective. That's what the strategy is. And now, when we talk about pricing, we already know what price is, the amount we have to pay on goods or services. But businesses, they need a pricing strategy, mostly probably for existing products or new products. Whatever products you have, either existing or new, you need a pricing strategy, because if you don't use, your competitors will use. So pricing strategies are plans about price, which allows a business to reach its marketing and corporate objectives. So when we talk about marketing objective, how are you going to be able to sell more of your products? And corporate objective, what the business is aiming towards. Do you understand what I'm saying here? With pricing strategy, it allows you to you're using one stone to kill two birds. It means you're going to achieve your marketing objective and at the same time achieve the company's objective. You can achieve both with market or pricing strategy. Do you understand what I'm saying here now? So there's a pricing strategy which allows a business, when the plan is successful, to achieve both the marketing objective and the corporate objective. The marketing objective is how you sell more of your products, right? And your corporate objective is what the business wants to get at the end of the year. Do we understand pricing strategy now?
Yes.
Okay. So I know the strategy is a set of plans that can be used to achieve an objective, which I already said that way. Then for pricing strategy, you have to reach your objectives. You can do that through pricing. That is what it means. So we're going to different types of pricing strategy. We have the first one, which is cost plus pricing. Cost plus pricing. It means we're setting a price based on the percentage of the cost. So there's always cost of production, which is the amount of money spent to ensure the product is made available for sale. Hello? There's cost of production. So your cost of production, like I said earlier, is the amount spent to ensure that the product is made available for sale. That's your cost of production. So when you're using cost plus pricing, it means you're setting a markup. That means the percentage of your cost before you decide the price. So whatever price you charge, it would have meant that the cost has been included. That's why we call it cost plus pricing. Do you get it, or I explain again? We call it cost plus pricing because we have set the price based on the percentage of the cost of production. And you know what the cost of production is, like I said, the amount we spend as businesses to ensure the product is made available for sale. So if we have known our cost of production, setting the price based on the percentage of the cost of production is called cost plus pricing. Do we get cost plus pricing here?
Yes.
So what is the benefit of cost plus pricing? It allows the business to know its profit if all goods were sold. So the point about this is this. As soon as you set your price based on the cost of the product, it would have meant that the cost price, the selling price is higher than the cost price. That is what it means. Do you get the point here? When you set the price above your cost price, it would have meant that your selling price is higher than your cost price. So if all goods are sold, it means you would know the profit you're going to make. If your cost price is 5, and with markup, cost plus pricing, you're selling at 6, and you have 100 products. So it means your cost of production is 500, right? If you sell all, it means 600. So your profit is 100. So with cost plus pricing, you would already know if you are making a profit or not. Because as soon as all your products are sold, it means you have made a profit of 100. You've set the price above your cost price. Your cost price is 5, your selling price is 6. So if all those goods in that market were sold from your business, if it's sold, then you have made a profit. So cost plus allows you, hello, put your head up please. Cost plus allows a business to know its exact profit. Do you understand cost plus pricing here? Do you understand or not?
Yes.
Do you understand? Do you?
Me?
Yeah. No. Do we understand it, please? The cost price is the amount spent to ensure the product is made available. The selling price, if the selling price is set above the cost price, it means that we've used cost plus pricing. Using cost plus pricing is advantageous because it allows a business to know when to make profits. Is it clear now, please? Now, what are the drawbacks or the problems about cost plus pricing? Number one, it neglects market conditions or situations. In that market, you are not the only business in the market, yes or no? There are other competitors on the market. But if you are setting your price based on cost plus pricing, it means you don't put into consideration your competitor's price. Do you get the point I'm making or not? Do you get it or not?
Yes.
Okay, I will explain again. The cost plus pricing, one of the problems we have, one of the problems businesses will have or encounter is that they do not put into consideration the market situation. In the market, we have competitors. So you are setting your price based on your cost of production. What about your competitors if their cost of production is lesser or lower than yours? Do you get it now? So it means you will be selling at a higher price than those of your competitors. Selling at a higher price than your competitors means you won't be selling as much as your competitors. Do you get it or not?
Yes.
So that's why I said it neglects market conditions, which means the price drivers are selling are not meant to be considered. This may result in lower sales. Why is there lower sales? You're going to encounter lower sales because your competitors are selling maybe lesser than what you're selling at a lesser price. Because you don't think about your competitors, you only think about the cost of your production. So thinking about your cost of production neglects the prices your competitors are charging. Do we get it now, please?
Yes.
Do you understand? Any question? No? Okay, we'll move on. So the next one. Costs related to products are complex. As a result, the business might not be able to identify the cost of the related products. When you charge cost plus pricing, cost is not something that we have fixed costs, we have variable costs, yes or no? So these costs are not costs that we can easily identify.